Hey guys, welcome to another Ultimate Edge webinar series. I'm excited about this one. I have my co-host, who is also my sister, with me, Marcia Murphy. Hi, Marcia. How are you?
I'm great, thanks.
Marcia's giving me the aloha sign because she runs the branch office in Hawaii. You can tell who's the smarter of the two by where they live. Okay, but moving on from that, today, I'm also excited because we're going to do 2025 predictions of the housing market, interest rates, all kinds of interesting stuff. We're giving credit to Barry Habib and his company. Barry's got a couple different companies here. Barry's well known in the mortgage industry. He's been on a lot of different TV programs. I know he's a best-selling author. He has gotten multiple awards for his predictions being amazingly right on. We follow him pretty much on a daily basis, guys, because Barry tells us which way rates are going, whether we should lock our loans today. We want to be proactive with our clients. Marcia has known Barry for how long, Marcia?
Well, I think I've been following Barry since the very early 2000s, almost as long as I've been in the mortgage industry. So
kind of tells you how long we've been in the mortgage industry. Absolutely. So
yeah,
Barry's one of our favorite guys. We're going to draw on his expertise here with some slides. And with that, Marcia and I have been in the industry, as I said, for longer than we like to admit. And we use his advice a lot. So let's dive in, Marcia. You can show a PowerPoint and we'll get going with what Barry has in mind.
hey, thank you. I'm looking forward to this. I think right now, kind of one of the number one questions that maybe this audience, our partners are asking is like, what is going on with the economy and what's happening with the rates and what is the prediction of the real estate industry? So I think you're going to find these slides really informational, John. Now, again, I did get these from Barry. So, and his source is the Fed. They call it FRED, the Federal Reserve Economic Data, which has a whole bunch of different economic data on it. 2025 forecast. And so these are going to be Barry's forecasts for what's going to happen over this next year. And last year, his predictions were almost spot on. I'm not going to go into what they were, but he was very, very, very close, and he's received awards, as John mentioned, for his accuracy. So we are going to go into a little bit of what the Fed is forecasting compared to what Barry's forecast. And Barry's forecast usually is a little bit better than what the Fed is saying. So you see my screen there?
Absolutely.
All right. So this is what is known as a dot plot. So what this shows, there is 19 Fed chairmen, and they all vote on a monthly basis. And this is the Fed's prediction of what the Fed funds rate is going to be at the end of 2025. So John, do you know what the Fed funds rate is?
I think I do, but I think it would be good for you to explain it a little bit more for our audience, Marcia. That would be great.
Well, every time, you hear the Fed is going to lower rates, the Fed is going to increase rates, whatever it is the Fed is going to do, I get that call, Marcia, mortgage rates are going to drop. It's not what the Fed funds rate is. It actually has no connection to mortgage interest rates, unfortunately, or long-term rates. It is the rate that banks charge other banks for borrowing money overnight. And it's a numeric number. Mortgage rates, long-term rates can follow in time. It does impact your short-term rates, like your credit card rates, HELOCs, those kinds of things. So currently, the Fed funds rate is at 4.375. So we had three reductions in the Fed funds rate last year in 2024. John, check me on that. Is that right? I think it was 3.
For a total of 1% a drop from the high of 2024 down to where it's at right now.
Okay. So you'll see there those little dots. Those each dot is a Fed member, a Fed voting member. So 3 of them project that the Fed funds rate will have 1 decrease this year, and it'll go to 4.125. Every time they move it, it's a quarter point. 10 members think that there will be 2 drops in the Fed funds rate, and it'll go to 3.875. Then 3 think it'll go to 3.625. 1 says 3.375, and 1 lonely soul says 3.125.
We're cheering them on, that's for sure.
Yes,
we hope they're
yes,
right.
We are, because that, as mentioned, it does not have a direct correlation to mortgage rates, but they do follow. So let's go to the next slide here. So the 14 members, this is the forecast for unemployment. So the things that, I should have started with, the things that impact rates are inflation and unemployment. And so this right here is a forecast of what the Fed thinks unemployment is going to do. So currently unemployment is at 4.2%. And it looks like 14 of the Fed members feel like unemployment is going to stay at where it is, possibly go to 4.3. Now, and 5 members think that it could go to 4.4, 4.5. How does that, what relevance does that have to mortgage rates? John, do you know the answer to that?
I would say that when the unemployment rate is high, that means that the economy is not doing really good because people are not employed, and the Fed's going to do whatever they can to improve the economy, which typically means lower rates.
Exactly. So they think, most of them think we're going to stay about where we are. Barry does have a different forecast for that, which we'll go over here at the end. He thinks that it's going to be higher than that, and that the Fed will then have to probably, that's why he's thinking that they're going to have more cuts this year because of the unemployment rate, which he thinks is going to be higher, 4.5, 4.6%, basically. Inflation is the #1 enemy of mortgage bonds, which is how mortgage rates are determined. What is the definition of inflation, John? Do you know?
Well, I think it was Milton Friedman said inflation is too few dollars for chasing too many goods.
That's very good, John. I am very impressed.
Well, I thank you, Marcia.
Too many dollars chasing too few goods.
Yeah, I did say it backwards, didn't I?
Yeah, you did.
Well, thanks for catching that.
But it was close, John.
Yeah.
So basically, inflation, if you have a lot of money in the economy and people are just, there's money is flowing freely, then what does that do to the price of goods? Makes them go up.
It causes them to increase.
Yes, it does. Okay. So as goods increase, that's bad for rates. And if as inflation goes up, that's bad for the bond market. And therefore, that's when inflation goes up, rates tend to go up. You can think of it like
the connection there, guys, is that when inflation is kicking into gear, that means that the Fed needs to do something about that. And so they want to slow down the economy when they're doing that. And to slow down the economy, they did what they did previous last year. They increase interest rates. That tends to have people stop buying so much because it's more expensive. When people stop buying so much, inflation starts coming down, and that's the goal. And the Fed has done, I think, a reasonable job over the last couple of years here. Inflation was at 8-something% a little over a year ago, and now we're down in the 3, a little below 3 range, right?
Yeah, we're currently at 2.8%, John. The favorite measure of inflation is the PCE, personal consumption expenditure number, and that is at 2.8 currently as of November in 2024. And John, what is their target?
Their target rate, guys, for PC is 2%. What they're
Yeah.
trying to get. The last percent or 0.5% is the hardest of all. That's for sure.
The what?
I said the last percent. They had a pretty good job bringing it from 8 down to here, but the last little bit is the most difficult of all to get it down there.
Okay. One of the biggest components of determining PCE is shelter costs, and that's measured by rents. And currently shelter costs are about 18% of what the PCE, the total PCE number. So as rents go down, that's going to help the PCE go down. Core Logic feels like current rents year over year are going up at 1.7%. The Fed thinks they're going up at 4.8%. That's a pretty big lag there.
Well, that's a big difference.
It's because those numbers come out about every 6 months. So the Fed's kind of behind. I'm not going to go over this because it gets a little in the weeds here, which I want to keep this kind of at a layman's terms, basically. But this chart here shows you what since, is that 20? I can't read that. Since 2022, I think. This is
2023, Marcia. February 2023 is the beginning of the chart.
Sorry about that. Okay. So since 2023 February, this is what the cost of shelter has done. And you can see it's just slowly but surely going down, and there are ups and downs along the route, of course. Okay. This one I'm not going to go over this one either. So annual inflation. So John, you were talking about inflation and what a good job the Fed has done. What a bit of a misnomer is that when people feel like when they hear, oh, inflation is under control, inflation is going down, they think, well, how come when I walk in the grocery store, the cost of milk is still $10 a gallon, right?
Marcia lives in Hawaii, guys, so be aware of that there.
Well, I think it's like that in other places too, but maybe eggs. So what this chart is showing you, the red lines there are showing you what inflation, as the ups and downs of what inflation has done. So you'll see it's jittery across the line there. But the purple line, that tells you where inflation is. And because even if inflation is at 2%, that doesn't mean your prices are going down. What that 2% is getting added on to what the previous inflation number is. So getting inflation under control doesn't necessarily mean that our prices are going to go down. It just means they're not going to go up as fast. Does that make sense?
It makes really good sense. So I understand what you're saying is that when we're at the 2% range or 2.8% right now, prices are still increasing just at a slower rate.
That's right. That's right. So I think many times last year we would hear how inflation's improving and everything, and people would run out to the store and be disappointed because the prices really weren't moving down much. Do you have any comments on that, John?
Well, a couple comments. Yeah, a 2% inflation is actually healthy for the economy, guys. And sometimes we think we want it to be deflationary, but deflationary has more problems than in slight inflation. So the Fed's target rate, as Marcia mentioned, is 2%. They get it down to 2%, they're going to not move rates one way or the other as long as it stays there, because they consider that a healthy economy.
Exactly. Okay, so moving on here to the labor forecast. So remember I said in the beginning, John, that what impacts mortgage rates is inflation, which we just kind of looked at, and unemployment, labor numbers. So you'll see here on this chart that unemployment has been steadily going up. I think that's since 2022. And I can't
Since
read
January
it.
2023, Marcia.
Okay, so there's been a couple dips along the route, but for the most part, the numbers is going up, the unemployment rate. Which is there's a lot of different reasons for that. I think this next chart here, there's two charts here that kind of explain why. This one is showing you that since over the last 7 months, when people lose a job, they go on unemployment. So people are trying to stay in their jobs, but when they lose a job, they go on unemployment. And the duration of months of time that people are on unemployment over the last 7 months has increased by 21%. So that means they're staying on unemployment longer because they're having a more difficult time finding a job.
Well, there you go.
Okay. Part of the reason that they're having a difficult time finding a job is because of this right here. Since from 23 to 24, company closings, layoffs is up 70%. So you'll see there on that chart, an example, Macy says they're going to close, I can't read that number, 68 stores?
65.
65 stores. So 65 stores times how many employees work for Macy's, right? Per store. So with all these closures, that's a lot of people that are going to be out of work. And then based on the previous chart, it would appear that there could be out of work longer than previously thought because they have a harder time getting a job. I hate all this doom and gloom, but it's just important, what's that, John?
There's just not as many jobs available.
No, there's not. So just something to be very, very aware of. The flip side of that is the job openings. They call this the jolts. And you can see right here, a year ago, there were 8.3 million posted job openings, and today it's 7.7. And Barry thinks that number is actually less than 6% because with the advent of people working from home, a lot of times they will go, job openings will be posted in multiple places, multiple states. So there's a double counting on some of those jobs.
Okay.
So again, this is kind of a doom and gloom picture here. But it does impact the jobs numbers and the unemployment numbers. Unfortunately, when they're going up and less people are working, that's good for mortgage rates because because the Fed realizes that they have to do something. So here is what the forecast for mortgage rates is. So this chart right here is the 10-year Treasury. And John, did you look and see what the 10-year T was at today?
No, I have not.
Okay. I think this morning it was at 4.66. And that was after there was some good economic news today. So it actually went down from I think it was 4.86 a couple of days ago. So the target for the 10-year is 3.6. So we have a ways to go. And John, do you know how the 10-year Treasury impacts mortgage rates, what that relationship is?
Well, there is a correlation there because most loans last between 5, 7, and 10 years. So 10-year Treasury, bond traders look at that and they're going to demand a higher yield if they think interest rates are going up. And so they bid on bonds and they want a higher yield, so rates go up. And that tends to, the mortgage rates tend to follow that curve pretty closely.
Very good, yes. Why would the 10-year go to 3.6 or less? That's our target. And where would that put mortgage rates? So this right here, so there's this thing called, this is part of the correlation between the 10-year, what the 10-year is, and mortgage and long-term mortgage rates. There's a thing called spread. So you see those two green lines there, John?
I do.
So that's kind of where the spread has been between the 10-year and the fixed rate mortgage rate. And I think the average has been about 2.5%. Now, so what that means is if the 10-year went to 3% and if the spread was 2.5%, the mortgage rates would be at 5.5%. And so that's kind of been the average. Now, last year, I want to say October, you see where where it went way up. And you see that October of 2023. Is that 23? Okay, yeah. So the spread, even though the 10-year had not gone up, the spread went up dramatically, and that's when rates hit 8%. So the goal is to keep that spread, is hopefully that we get the spread back to where it's averaged for the past very many years, in that between those two lines there, average being 2.5%.
Well, yeah. So the normal spread that we tend to see is between 1% and 2%, which is what those two lines are. And currently we're at 2.5, so we're still above where the normal spread would be between the 10-year Treasury and mortgage rates. Right, Marcia?
Yes, exactly.
So we would anticipate that that's going to narrow because it is going to happen over time one way or the other. And that means that mortgage rates could come down to help make the spread a little less between the 10-year T-bill, or the 10-year T-bill is going to go up, or a combination of those two things.
Exactly. So a lot of investors, as John mentioned before, what helps the 10-year improve is money moving into the bond market and investors buying more treasuries, right? Currently, money markets are where most people are putting their money because the yield is about the same as the treasury. But as the money markets yields go down, hopefully here over the next year, more money will be moving into treasuries, which should help our yield.
Yeah, supply and demand. When we have more money buying bonds, that means that the yield comes down on bonds because there's more people buying the bonds, guys. And so the interest rate that they can get is a little lower, and that tends to bring the bond price. Bond prices are higher, the yield is a little lower. That's how it works.
Okay, so here is an example of where mortgage rates could go if the 10-year does come down to this goal of 3.6, and if the spread narrows to 2.25. This is all Barry's thinking that this is where we're going to be by the end of the year. If this was the case, then where would the mortgage rate be at, John?
The difference between those two.
Well, the
addition between those two.
5.85.
Exactly.
Right.
And Marcia, I was listening to another webinar just recently with Dan Ratledge. Do you know who Dan is?
Yes.
And Dan is right on with Barry here. He agrees, mostly because of the spread there. He's thinking rates are going to be down in the low 6s to high 5s, possibly within this year. And looks like Barry agrees, which is pretty amazing to me, because I suspect you have some rate forecasts from other sources coming up, Marcia. Is that true?
No, we'll summarize this all here at the end, but this is
Okay.
where Barry's forecast is. The Fed and Fannie, I don't think they're quite where Barry is, but I don't have those predictions with me
Okay.
today.
All right.
I did want to mention, well, I don't know, went in my brain and then it went back out. So let's move to the next section here.
It'll
So
come back.
I think that this right here, the forecast for real estate, I find this really, really fascinating. That, when we look at the demographics, the US housing market, it all makes such good sense once you kind of understand the numbers. So what this chart shows you here is the total number of houses in the United States is
136 million.
million.
Yeah.
And of the 136 million, 45 million are renters. And that would leave the remaining at 91 million are people that own homes. And then if you look across there, you'll see that the total equity of those people, well, what's the equity, John, of people that rent?
Zero. Nada.
Zero.
Nothing.
Okay, so if you rent, you don't have any equity, unfortunately. Those owners, that is a total of $37 trillion in equity. That is massive. And that equates to 407,000 in equity per homeowner, average. So I find that's quite interesting, and there's a lot of wealth there. Do you have any comments on that, John?
I think it's very instructive, guys. We had a webinar just recently that talked about this very thing. We know that there's an affordability gap right now. It's hard to buy homes when you're first getting started to buy a home. And so many people delay. If you can figure out a way to get into a home, as you can see from what Marcia says here, you're going to be part of the households that has that equity in your balance sheet, and it's going to increase your wealth. It's quite worthwhile if you can figure it out. Most wealth is built in real estate in the United States.
So, oh yeah. So of those homes that are owned, you'll see 35 million of them are owned free and clear. So they're, of course, have, 100% equity. And 56 million of them have a mortgage, but there's still a ton of equity there, 17 trillion, which equates to about 311,000 per household. So again, there is a lot of wealth there in real estate. Now, I'm going to have a hard time with this, John. You're going to have to help me because I can't really read those numbers. But
yeah, I can read them for you if you need.
Demographics here. So John, go ahead and the first column there shows the number. Go ahead.
The current age is so you'll see there's 4 different age groups there, guys. The boomers, Gen X, millennium, and all down to Gen Z, and it shows the age brackets for them there and how many of them are in the population. So 71 million people are boomers, 65 million are Gen X, 73 million are millennial. Millennials are larger than boomers now. How about that?
Yes,
and
they
Gen
are.
Z is 69 million. Yep. But the boomers still have 74% of the homeowners are the boomers. Oh, I see that I'm a little off there. So of the boomers, 74% of them own homes. That's what that's saying. Of Gen X, 65%, millennials, 45%, and Gen Z, of course, are those sort of first-time home buyers. They're just 12 to 27 years old. 8% of them of that group own homes, which is pretty phenomenal, actually. And HO, household rate, when they were 30, is that what that means, Marcia? HO rate?
Yeah, it's like when the boomers hit 30, that percentage of them were homeowners at
Got
that
it.
point in time.
Got it.
Um,
Okay, so
and
that would be
then when they
compared
hit
to,
40, you can see the span there between 30 and 40.
right.
And what does that mean for our millennials and our Gen Zers?
Well, see, the millennials are 28 to 43 years old, and they're currently 45% of them own homes. Back when the boomers were that age, 65% of them, and Gen X 59%. So they're a little bit behind times, but not so much, but a little bit, yeah. And same when they were 30 years old. So the 30-year-olds are the millennials. Currently 45% of them own homes, but they're right on. The boomers, when they were 30, it was 48%, and the Gen X, it was 42%. What I don't understand is why the HO rate when they were 30 for millennials is 33%, and yet 45% of them own homes. I'm a little confused by that. And when they turn 40, 55% of them. So I guess what that is telling us is that on that age group there, the 30-year-olds don't own nearly as much percentage of home as the 40-year-olds in the millennial group, because 55% of the millennials owned homes when they were 40, and only 33% of them owned homes when they were 30. I get it. Okay.
Yeah,
So
yeah,
younger people don't own as much homes as when you're older, which kind of makes sense. You build wealth more when you get a little bit older in life.
and there's a lot of potential. You know, the median age of the millennial, I think, is 30, and so over the next 10 years, a lot of them will be, you know, out in the market owning homes when they hit the 40. So
Yeah,
there's a lot
these are
of growth potential there.
yeah, largest part of the population anymore is millennial.
So we kind of went through that already. So I'm going to go to the next slide here. So this is a slide that shows active listings at these given points of time. So John, what is the first date on there? Clear to the left.
January 2017.
Okay, so in 2017, how many active listings were there, John?
Oh, about 1.4 million or so.
1.4 million. Yep, I think you're right on. Compared to, and then we've seen that go down over the years, right? And the lowest dip there was, what year was that, John?
It's January 2022, and it's less than 400,000.
Of active listings. So
big
that was
drop.
during COVID, right? So wasn't a lot of people selling at that point in time. And now it's gradually coming back up, but we're still not to where we were pre-COVID, basically. And this is all going to come together. We just went through the demographics, and now we're looking at the listings. And there is a point to this, which we're going to get to here in a minute. Let me go past this. Well, yeah, that right there tells you since 2018, there's 21% decline in active listings.
But year over year, plus 27%. So it's going the right direction.
It's going the right direction, is correct. Okay, now this is all, again, John, this is all going to come together, because it might seem like, why are we all
I
over the
am
map
so
here?
anxious to see it come together, Marcia. You have
Well,
no
we're
idea.
gonna
This is
get
exciting.
there. So household formation. Okay, this is an interesting, I mean, I would never would have, had I not seen this, knowing that every year there's about 1.9 million household formations. Now, what do you know about those household formations, John?
Well, I know from this chart that it really dipped between 2021 and 2022 a lot, but it
But
bounced back up.
you also know that for the most part, they're going to need shelter, don't you think?
Yes, either renting or buying, right?
Either
So
renting or
household
buying.
formations, is that mostly people getting married, Marcia? Is that what we're talking here? Or
I believe that would be people getting married and starting a family.
maybe not getting married, but coming together to start
Coming
a family.
together and starting a
All right.
family, a household.
Makes sense.
You know,
All
if
right.
we're single now, they're a formation, right?
Right. Okay.
So remember that 1.9 million every year. So let's go here and see what our housing starts are, John.
Oh
So
my.
this is new builds, right?
Yep.
And again, where was that? What year was that big dip there?
2000, and it was between January and July of 2020.
Again, during COVID. But you'll see there that it's a little jagged, of course, ups and downs, but the range for housing starts is between 1.3 and 1.6 million annually. What did we say the formations was?
1.9.
1.9. So there's a little bit of a shortage there.
Yes, there is.
1.9 to 1.3, right?
Yeah,
basically,
600,000 short.
Yep. How much short?
600,000 households.
Yeah, that they need someplace to live. So the part of the point of all this, John, is, I think we've been, I don't know, I hear this on the media. I don't know if you hear it, but how there's going to be a housing crash. So I think last year, there was a lot of forecasters saying that the housing market can't keep going and it's going to crash and the prices are all going to come tumbling down. Okay. But housing, real estate, it really is as simple as supply and demand. That's kind of where we started this presentation.
Agreed.
Yeah. So, what happens, John, if we don't have we have a huge demand of 1.9 million households, but we only have 1.3 housings available. What happens to prices?
Prices of houses will increase because you got all those people chasing too few houses.
Yes, theoretically, there's the supply is not enough to meet the demand. So there's a very good reason to anticipate that prices will, it's all, based on locality and where you live and all that. But in general, based on these stats, that it's probably a good bet that prices will continue to go up because of the demand.
Yes.
You can disagree with me if you wish.
Well, I think overall you're exactly right, Marcia, but I think you've also nailed it that it's very localized. And so if you live in Seattle, the housing gain may be different than if you live in the Midwest someplace. But overall, real estate increases at a 4% per year through good times and bad times because there is that desire for household.
Yep. I'm going to go past this slide because I want to get to Barry's predictions. MBS. That was the Fed, but Barry is usually way more on than the Fed. So
are you saying Barry should do the monetary policy for the United States?
Yes,
Is that what I'm hearing?
I am saying that.
All right. All right.
He paid me a lot of money to say that, by the way.
Go Barry, yeah.
Okay, so Barry says that appreciation is going to range between 4 and 4.5% year over year in 2025. What do you think about that, John?
I think that seems reasonable. That's kind of what it was last year, depending on where you're at. The last webinar I was telling Marcia that we did, the west side of the United States was actually lower than that, interestingly enough to me. It was in the 2.8 to 3 something range. Mid was about that, and the eastern part of the United States was in the 5 to 6% range. I was really interested in seeing that.
That is very interesting. Yeah, it is very localized. There's no doubt about it. There's a lot of factors that can impact your locale.
Well, yeah, when you're in Seattle or Los Angeles, poor Los Angeles, or San Diego or in San Francisco, where housing prices are close to $1 million as it is, yeah, 4% increase is a fair amount of money for those folks. But when you're in the Midwest, when the housing price is $138,000, you know, it's not quite as much relative money speaking between the two, you know. So there is some difference, I'm sure, in housing price, the cost of the home and the appreciation you're going to see.
Exactly. Okay. Now, core PCE inflation, he thinks that it's going to be between the Fed, you know, we're currently at 2.8. He thinks that we're going to hit somewhere between 2.1 and 2.2%.
Yay, Barry.
Yay. What's the target?
2%.
2%. So we're getting down there. We're getting close to where we want to be. Unemployment, Barry thinks is going to go 4.5 to 4.6. And remember,
Okay.
the Fed, most of them think we're going to stay at 4.2 to 4.3.
Okay.
Barry feels like based on the charts that we went over, the closures and all that, that our unemployment is going to go higher. What does that
All
do
right.
for our interest rates?
Well, it's going to cause the Fed more than likely to try to lower interest rates a little more to stimulate the economy to lower that unemployment rate.
Exactly. His prediction is the Fed funds rate is, what is it currently at, John? 4.375.
Well, I think you said 4.6 today, right? When you looked at it?
No, the Fed funds rate. It's
Yeah.
currently,
Oh,
I
that
think
was the
it's,
bond you were talking. That's
yeah,
right. Thank you.
yeah, it's at
I'm sorry.
4.375, and Barry thinks it's going to go to 3.25, between 3.25 and 3.5. And so remember where we talked about the spread? So between the Fed funds rate and rates.
Yeah, 2%, 2 point something percent.
Well, yeah. So if it's, you know, based on the 2.5 or where, you know, where we think it's, hopefully it's going to line out at, mortgage rates should be in the 5.75 to 6% range, according to Barry. Where are we at today, John?
Oh, high sixes, maybe 7.
Okay, today is January 15th, 2025. So we got a little ways to go.
Yes, we do.
Okay, so that's that. That kind of is a wrap up here. Is there any questions, comments?
Marcia, a couple comments from me, your audience here, is that, guys, if you're thinking about buying a home and rates are high right now, Marcia just showed you a couple of really fundamental things. One is that there is an undersupply of homes for the demand. There's going to be more demand for homes than there is supply. That's likely to push rates, or excuse me, prices of homes higher. Barry says 4%. So that $400,000 home you're looking at is going to be worth $416,000, or maybe a little bit more than that next year. So you're waiting for that. You're going to be buying a more expensive home next year. Now, potentially you're going to be buying at a lower rate, so that's good. But chasing that appreciation, I've seen buyers try to do that, and getting a little more down payment maybe to keep up and everything is just an impossible thing to do. Another approach, which we talk about with our clients, is if you can buy now, even with rates in the 6-7% range, buy now. And when rates come down to 5.75 or whatever, and you have a 6.75% rate, you can refinance, and that home equity is yours that Marcia talked about, that 30 or 60 trillion dollars. That was at 30 trillion, I think, 30 points to some trillion dollars of home equity in the United States. You're going to be part of that. And that way you can refinance and get the lower mortgage and still not have to buy the house at the higher price. We can show you some pretty good data on that, that is a pretty good way to increase your wealth over waiting for rates to come down, because you don't know if rates are really going to come down. And home prices are pretty accurately, they increase 4% or more per year. It just seems like they continually do that. What do you think, Marcia?
Another bullet point, John, just is that while rates are higher, 7-ish, 7.25, wherever they are, maybe there's not so much competition out there for you as a buyer, and therefore maybe there's not going to be all those bidding wars that are driving that price up, like
Such a
we
good point.
saw
Yep.
previously. So, so that's something to also keep in mind. And
That's a
a
really,
lot
really
of
good
buyers
point.
are actually, jumping into the market because of that.
Yeah. Yeah, if you think price hikes, you think price is increasing now, wait till rates hit 5.75
Yeah,
and all those multiple buyers come out of the woodwork and start making offers on homes. It's a good, very good point, Marcia.
yeah. Okay, well, thank you very much. It's been a pleasure, and might have been a little rough going there, but hopefully this was informational for everybody.
It was informational for me. So I think you did good, Marcia. Thanks for the information. There's a lot of information there, guys. If you're part of our YouTube channel and you wanted to continue to receive information like this, make sure you subscribe and reach out to us if you need to. If you have any specific questions in your particular situation, this was kind of a macroeconomic discussion that Marcia did today, but we'll take it down to a microeconomic level for you just to see how you fit into this and what you might be able to buy and whether it makes sense to buy. Maybe you're an investor, you're thinking about buying another home for investment purposes. We work with all kinds of buyers, first-time home buyers to whether it's your 30th home. We're happy to chat with you. Thanks for the information, Marcia.
You're very welcome. Thank you.
All right. See you guys.
Aloha.